Capital FX signals. Trend reversal patterns. Head and shoulders pattern. This is a bearish reversal pattern, which forms after a strong move upwards. It consists of three peaks: a left shoulder, a large central peak, also known as the head, and a third and final smaller peak, a right shoulder. All three peaks need to have a neckline which connects all the lows of the three peaks. Now let's take a look at the chart. In an uptrend, the first peak forms. After a small retractment, price pushes higher, creating a higher peak. But as the bullish trend gets exhausted, bears drive the price down again. Bulls see this as an opportunity to buy, but this time fail to reach the previous high. Bears then begin to take control, driving the price back down again. Just like a double top pattern, the sell position should only be taken after the neckline is broken. Otherwise, you may get caught up in a consolidation phase before the uptrend resumes. This type of pattern can produce three different necklines. The first one is a neckline with a rising slope. This type has the largest probability of failing the pattern as the price is still trending upwards, creating higher highs and higher lows. The second type is a horizontal neckline. This is our favorite type as it is the easiest to spot, meaning others are also likely to spot this pattern. The third is a downward sloping neckline. This type of head and shoulders formation is the most reliable reversal signal, as it is consistently creating lower lows and lower highs. The price target for the head and shoulders formation should be the height from the neckline to the top of the head, measured down from the breakout point. To summarize, remember the key points. 1. Three peaks, with the middle one being the highest. 2. Neckline is visibly straight. 3. Neckline is broken. Don't forget to subscribe and leave any questions below in the comments section.